The economy seemed to hit a soft patch this summer, but stocks carried onward and upward. The S&P 500 advanced for a fourth straight quarter. Markets were notably placid for much of the quarter, even with two major banking scandals, multiple terror attacks, and the latest dispatches from an especially contentious presidential race in the headlines. As the third quarter went on, the Federal Reserve all but signaled to investors to expect a rate hike before the end of the year. Home sales, residential construction, factory activity, and consumer spending seemed to wane in the quarter, but consumers grew more confident. As Wall Street mulled over the chances of a fall interest rate increase, some economic indicators pointed to a summer slowdown. Both industrial and manufacturing production declined slightly. Durable goods orders were up for July, but were suddenly flat. Retail sales fell and personal spending was flat after experiencing a gain in July. However, personal incomes did manage to rise another 0.2%. The pace of hiring also moderated in August through July's numbers were revised upward in September. The headline jobless rate, the U6 rate, counting the underemployed, the unemployed, and the labor force participation rate were exactly the same in both months. Other indicators were less dismal. As September ended, the federal government said the economy grew at a 1.4% pace in the second quarter. Not very good, but better than the 1.1% growth previously estimated. Accentuating the positive, consumers grew more upbeat as the quarter went on as consumer sentiment rose slightly. Consumer inflation picked up, but wholesale inflation did not. The Federal Reserve left interest rates alone during the third quarter. It did, however, clue Wall Street in on a probability of a fourth quarter rate hike. Its latest forecast showed consensus for one, and the vote against raising the federal funds rate at its September policy meeting was close, 7-3. After the vote was announced, Fed Chair Janet Yellen remarked that the members were generally pleased with how the U.S. economy is doing, a notably sunny viewpoint. Wells Fargo certainly made headlines in the third quarter. In September, its CEO was brought before Congress after news broke that employees had opened as many as 2 million fake accounts in pursuit of sales goals. The bank was contending with $190 million in fines and severe damage to its reputation when the quarter ended. Trouble at another even larger banking giant emerged during the third quarter. Deutsche Bank looked increasingly shaky after failing the U.S. government's bank stress test early this summer and barely passing the equivalent test in the European Union. S&P Global Ratings lowered its outlook for Deutsche Bank to negative. By the end of the quarter, CNBC and AFP were reporting that Deutsche Bank was trying to negotiate $14 billion of fines it owed to the Department of Justice down to the $5 billion level. Indications were that the German government had no intention to bail the bank out should its situation worsen. In September, OPEC nations agreed to reduce oil production for the first time since 2008. The agreement, to be finalized in fall, would essentially restore the production levels that were in place back in 2015. Previously, Saudi Arabia had held out on such an agreement, saying it would cut production only if all other OPEC and non-OPEC oil-producing nations vowed to do the same. In the commodities markets, gold lost just 0.3 in the quarter, while silver rose 3.2%. Like gold, oil was nearly flat for the quarter. Home sales and housing starts tapered off during the quarter. Existing home sales slipped as inventory slimmed. The National Association of Realtors also said pending home sales were up in July, but down a month later. It's July. The Census Bureau announced that new home sales were up a whopping 13.8% and near all-time peak, but then they fell 7.6% in August. Also, home loans, broadly speaking, grew slightly less expensive across the third quarter. Tech shares and small caps set the pace in the third quarter. The Dow ended the quarter up 2.11%, the Nasdaq up 9.69%, and the S&P 500 up 3.31%. This is a time of year when bulls yearn for an extended rally. Will they get it? Will S&P 500 earnings surpass low expectations? Will the market confidently ride through the election, whatever the outcome? Will it simply and calmly price in a rate hike, assuming that happens? Will investors shrug off any unsettling headlines, whether from home or from overseas? If the market can answer yes to those last four questions, the quarter could see impressive gains for the major indices. The past has little or no influence upon future market behaviors, but even with continued slow economic growth, the overall market mood is still bullish. So perhaps investors will look at earnings first this quarter, then other factors. It is sure to be an eventful and possibly turbulent 3 months. That concludes our update for the third quarter. Our next commentary will be available in January. As always, thank you for placing your trust in Life Plan Financial Group. We hope you have a great fall and enjoy the holidays.